So let's talk about the Chinese economy. Beijing is holding their two sessions meeting and it's a huge event that outlines the future of the Chinese economy. China just set a bullish 5% growth goal and almost immediately people assume that Beijing is going to prop up the real estate market once again. The call has been to inject stimulus to prop up Chinese property to stem deflation. But that isn't the long-term goal of China's economic push. Xi Jinping wants China to transition towards technology and high-value manufacturing. And once you see everything through this lens, everything else will start to make sense. During the report to the National People's Congress, China's governing body, there was one key phrase mentioned 25 times, and that is the push towards high quality development. And this means avoiding the trap of using debt to fuel growth that isn't sustainable. Real estate in China isn't a sustainable model. The more money you put in, the less you'll get out. The economist Al Arian tells us the truth. If you simply crank up this engine that's becoming less efficient, it will produce less in terms of growth, it will produce low quality growth, and it will have adverse side effects. The West is still trapped in the idea of using stimulus to prop up real estate, and that's because it is the most direct way to boost GDP. You pump money to the system, and then people buy more homes. It's very direct. However, there will always be a limit, and you'll hit a ceiling sooner or later. Only this time the country will be in more debt and nothing substantial gets built. Industries will flounder and lose ground. And if China goes down this road, they will end up like German manufacturing today. In the meetings, China forecasts a 5% growth in 2024. Now understand that no matter what growth target they announce, analysts will be screaming doom and gloom. If Premier Lee said that the target is only 4.5%, then the headlines would say China's growth is over, that the collapse has begun. And with a 5% target today, they are calling China delusional, that this is a target without a plan. China's GDP targets have been dropping year after year because the economy is now growing from a higher base. Trying to grow 5% today is going to be a challenge versus 7% back a decade ago. And this is what's triggering investors in the West. If China's going to grow at 5% this year, obviously they need to pump in more money. Beijing needs even more stimulus. And this is where China triggered a meltdown in the West. They set a fiscal deficit target of 3% again in 2024. They believe China isn't taking their GDP target seriously, and the 3% deficit isn't enough. And if the global economy is slipping to recession, the only way for President Xi to guarantee a 5% growth rate is to prop up real estate again. And this will trigger the wealth effect, right? People will feel richer and then they start spending more. But that is not what China's going for. It's important that we understand the big difference between China's economy and the US economy. China selling their debt is very different from the US issuing bonds because the US has the reserve currency, the dollar. They can borrow endlessly. Worst case scenario, they can print money to dilute the world's dollar holdings. China can't do the same thing. They don't have that luxury. So whatever debt they take on has to be targeted. And one thing's for sure, it's not going to bail out all the real estate developers. China doesn't want to blow up a bigger property bubble. However, there is a big shift here. If you look at China's economic targets, we can see a big change in debt issuance. China has announced a trillion yuan of special sovereign bonds, and this is the fourth sale over the past 26 years, so it's very significant. The last one happened back in 2020, and this is the central government in China borrowing almost $140 billion to boost the economy. The local governments in China has been in crisis for quite a while, so it's up to the central government to issue debt to fuel spending in the country. But where is the money going to go? At this point, it should be quite obvious, right? It's likely going to build up China's industrial base, is to push China closer towards high-tech manufacturing, especially when they are in an economic war with the US over chips. During the meeting, Li Qiang once again re-emphasized China's intentions. The focus is still towards tech innovation and upgrading industry, and this includes new energy cars, hydrogen power, and commercial aviation. So we need to look at a 5% GDP growth as a sort of distraction or red herring. Reaching it won't be easy unless they print tons of money and prop up real estate again, but that isn't the end goal. Since 2020, they have been giving out more loans for manufacturing and industrial projects. Loan growth for industries have gone from 5% a year to nearly 35%, but at the same time, real estate loans have collapsed from 20% down to 4%. And this shows you the priorities of the Chinese government. The special bonds could be channeled towards these industries, but it won't immediately increase GDP like real estate. China's trying to secure their economy for the long game. They're trying to do an economic reset while controlling the real estate implosion. It's not easy. So don't expect a big economic miracle in China for 2024, right? This is going to take quite some time. But what's interesting is China's military budget. The defense spending is continuing to rise over the past 5 years. It's not just Russia and Europe that's embracing the military, but China as well. China's expenditure is going to grow at 7.2% this year. That's a 0.6% increase since 2020, and this is going to contribute more towards their GDP as well. China has set a 2027 deadline to modernize their military, so this amount could ramp up very easily. Defense spending is only around 1.2% of China's GDP. The US is over 3.5%, while Europe is under 2%, so there's a very big disparity here. And this is one economic lever that China could definitely pull, especially if things keep heating up in Asia, if things keep escalating in the Indo-Pacific. And talking about that, let's talk a bit about Argentina. Things aren't looking very good in the country. Prices are still sky high. Malay shock therapy is destroying jobs and the economy is feeling the pain. Spending plunges at shops in Argentina with Malay's cuts hitting hard. To no one's surprise, firms are seeing double-digit sales declines for the third straight month. And it's obvious why. Inflation is over 250%, and that is destroying real wages. When your buying power is collapsing at that rate, you'll rush to swap your pesos for dollars. Your priority is to stem the bleeding and not head for a shopping spree. Just look at the disaster in consumer spending. It plunged by 14% in December, 29% in January, and crashed again by 26% last month. When shoppers cut back, it doesn't just affect the store owners, it affects employees as well. When people stop buying stuff from local businesses, that means lesser profits, right? And that means less money to hire people and more job losses coming. So Argentina is going to face a record labor crisis very soon. Not only is Javier Milei firing government workers, the private sector is also contracting. And this is going to complicate his fight to save the economy. Can you restore financial stability when employment is collapsing at a record rate? But that's not all. There's another economic disaster coming, and it has to do with the bond market. Argentina peso bond puts are ballooning out of control, which is building a new inflation risk. It's so bad that the puts in the banks are higher than their monetary base. This is quite simple to understand. Puts are basically pledges to buy back the bonds if they fall below a certain price. And this is a big reason why Argentina still manages to issue peso-denominated bonds. However, this is very dangerous to Argentina's balance sheet and the central bank. By giving a put on their bond, the central bank is obligated to buy back bonds from investors even if prices have collapsed. And let's say I buy an Argentine bond worth a million pesos and my put is at 90% of the value. If the bond value collapses down to 500,000 pesos, I can still sell the bond back to Argentina, the government, their central bank, at 900,000 pesos. It will be their central bank who will eat the loss, and this is a guarantee that lured investors back into Argentine bonds. The amount of puts today exceeds Argentina's monetary base, 14 trillion pesos in puts versus 10 trillion in money. And if enough sellers start dumping Argentine bonds, the central bank will have no choice but to print money once again. They will have to increase the money supply to pay back the bondholders. And it doesn't take a genius to realize what this will do. It will make the inflation problem even worse. People will dump the peso even more, they will run to dollars, and the exchange rate will collapse even further. Argentina is essentially caught in a bind. If they give this guarantee, they could face a bigger inflation crisis should investors dump their bonds. We can see Argentina's official exchange rate is still lower than the market rate. There's still a 39% gap. There are still more devaluations coming, and that could cause investors to dump their peso-denominated bonds. This will screw the central bank and they have no choice but to print money. But if they remove the puts, who's going to buy the bonds? The February auction was a disaster, with banks avoiding Argentine debt like the plague. After the limit was imposed, February's demand for government bonds fell by nearly 70%. That is a big problem for Argentina. They still need to sell bonds to raise money to prevent an immediate inflation crisis. So this is a horrible catch-22 for Malay. No matter the choice, higher prices in Argentina aren't going to end just yet. It might get even worse. But let's do an update on de-dollarization because something big just happened. BRICS have just laid out the foundations for a new common currency down the road. Russia has announced the creation of a blockchain-based payment system for the BRICS bloc, and the main use of this will be to facilitate more bilateral trade in local currencies outside of the dollar. According to the plan, the main thing is to make sure it is convenient for governments, common people, and businesses, as well as cost-effective and free of politics. Now, one of the main challenges in competing against the dollar is the need to find a platform that removes counterparty risk. Is there a way where transactions can be made safely? Take the Russian sanctions for example. When Russia was cut away from SWIFT and the dollar system, there was an initial period of extreme pain. Moscow couldn't transact with the world in dollars as easily as before. And because the US controlled the flow of dollars, they actually managed to hurt Russia's credit rating. Back in April 2022, the US blocked the Russian government from paying bondholders of their sovereign debt. $600 million of interest and principal payments were blocked because the money were just sitting in US banks. As long as you transact in dollars, chances are the money will have to go through many intermediaries, and this includes clearing houses and US banks, and at every point there will always be counterparty risk. And this goes beyond asset confiscation. The US can always block your dollar payments, which could force a government into default. Fitch, for example, downgraded Russia's rating to junk status. It was not because Moscow was broke, but because sanctions prevented them from doing so. They couldn't pay back bondholders in the US. And when you get downgraded, that lowers your credit rating and makes borrowing even more expensive. You now have to borrow at high interest rates. So you can understand why BRICS would like an alternative system to bypass the dollar. And here's the beauty about blockchain. No one can block the transactions. If it's a truly decentralized system, it's unblockable. So China can transact with India, Russia can trade with Iran, and it's all peer-to-peer. No one outside the system or even within the system itself will be able to exert influence. Now, will it destroy the dollar tomorrow? No, it won't. But it does set up a system where the BRICS nations can sanction-proof themselves and trade more easily in local currencies. It solves the big question of trust and transactions are kept confidential between both parties. That makes it harder for the G7 to track and pinpoint assets to sanction as well. With a blockchain system, BRICS can start chipping away at key parts of the dollar's hegemony. As it stands, the dollar accounts for 88% of FX transactions, 50% of trade invoicing, and 35% of cross-border loans. And all these categories will be under attack once the new system gets launched. It will make local currencies more valuable and easier to transact versus the dollar. A BRICS blockchain system can make trade even more secretive within BRICS itself. So don't be surprised if one day Saudi Arabia starts selling oil outside of the dollar through this platform without anyone knowing. Now I have to emphasize that this won't be an overnight affair, it's a long journey, but it does show the desire of BRICS to break away from the dollar in global trade. So here are the takeaways. China's economy is undergoing a big pivot, and it's very important to look at what they do and not what they say. Their 5% GDP target is likely a cover, a red herring to prop things up, while they focus on their true intentions, which is building an even stronger industrial base. Inflation in Argentina isn't over as well, and the recession could get even worse. Whether Milei can reach the finish line is really in question. It is very uncertain. And finally, BRICS, they are taking concrete steps to improve bilateral trade. It will take some time, but de-dollarization is still proceeding as planned. But let me know what you think. What is China's plan to grow their economy? And is the BRICS payment system a feasible idea or is it just ridiculous? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.